What do you feel when you hear the word tax? Tax is something we all have to pay, and let's face it, we need it to make the world go round. But how can we avoid it? Legally, of course. Today, I'm going to talk to you about how I've avoided paying over 100,000 in tax. But wait, before we begin, we need to make a clear distinction between tax evasion, which is not paying the tax you're actually due to pay, and tax efficiency. Our goal is to be as tax efficient as possible. So we're not paying more than we need to, because we should all pay our fair share. Tax can be dated right back to the times of ancient Egypt and antiquity in Rome. The Romans introduced public taxes. The more money someone had in their property, the more tax they paid. And in China in 10 AD, they introduced a 10% tax on all profits for professionals and skilled labour. Income tax was introduced in the UK in 1799 by a man called William Pitt in preparation for the Napoleonic Wars. The tax began at 2 old pence on every income over £60 per year. Fast forward to today, and last year the government is expected to receive £820 billion. As a society, we're taxed on absolutely everything. Our wages, our petrol, our food, our clothes. When money's earned, VAT is charged on that money. And then we pay tax when we're paid an income and on everything we buy. We buy a house, we pay tax to maintain that house and live in it, and then we even pay tax when we die. A nice thought, right? Then when you see the national debt is at 2.2 trillion, the equivalent to 103.7% of GDP, gross domestic product, it's like... That means we're generating more debt than money we're producing as a country, which is leading us into a recession/mortgage crisis, which is causing some strategists to call the UK economy one of the most vulnerable. Personally, I have a love-hate relationship with tax. On the one hand, my brother's a police officer and his partner's a nurse, and my partner's a teacher, so I completely understand that we need tax to make the country run, and they do an amazing job, so shout out to our key workers. But on the other hand, when I get my £20,000 tax bill each year, I'm like, ugh. So when it comes to my investments, I've already paid a ton of tax on that money, so I really want to be careful that when I'm investing, I'm paying as little as I can. Now that's not to say when my pot grows in the future, I won't give money to charity, for example, but on the way up, I don't want my gains to be halted by tax. In over 12 years of investing, I've built up over 220,000 and I paid zero tax on those gains. So let's talk about how I've done that, and I'll give you some tips on how I suggest you should do exactly the same thing. First up, we need to reduce our tax bill as much as possible. This is always the most important thing that I do first, because the less income we take home, the less tax we pay. Okay, of course, who doesn't want to make as much money as possible, but hear me out. In my situation, I run my own business. So that means expenses are deductible from my profits. So say for example, I need new equipment like this fancy computer, new camera or desk chair, I'm able to claim it. And in a lot of cases, I'm able to claim the VAT back too, since I'm VAT registered. Have you ever wondered why ABBA wore such ridiculous outfits? It's because they were allowed to write them off as a tax expense, as long as they were too ridiculous to wear off stage. I've also got people working for me, freelance web designers, and now more recently my editor, along with other ongoing costs I have like servers, software, subscription, and tools, which all go against my profits. I also do things like invest in training, which I actually think is way more important than people think. Now I know the vast majority of people will cringe when they hear the word course, because there's this opinion that nobody should sell you a course and just work endless hours to give you that content for free, which is great for the few millionaires who are able to do that, but it's not real life. I worked out yesterday the amount of time it would take me to make one course would be a minimum of 8 to 10 weeks work full time. Now don't get me wrong, the people who hate the courses may have that much free time that they can justify it, but I certainly don't. I've taken plenty of courses in my time which have been super valuable. I mean, even recently I invested in a YouTube thumbnail course and I've been a trained graphic designer for 13 years, which was actually super well presented and really valuable. I think investing in yourself is one of the best investments you can make. So combined, all of these things really help to bring my tax down. Heck, even a brand new Tesla can be claimed against your business expenses now. Okay, I know it's not quite that simple, but it's a very good benefit. And I can also control when money is paid to me, which is a perk of being a business. I can keep money in the business I still have to pay corporation tax and VAT, but I can choose when to pull that money out and when to put it into my account. And that dictates how much I've been paid. What I do is I draw a dividend from my company, which is similar to the dividends you would get on the stock market. I choose to vote myself a certain value of dividends plus my basic salary. And combined, I've always kept them just under the higher tax bracket, which is $50,271. I haven't always earned that much money, but luckily I've been able to for the past 4 or 5 years. Now you might think that's good for you, you're in a company, but I can't do that. Well, just remember, I don't get anyone contributing to my pension, I don't get paid sick days, I don't have any chance for redundancy, and I don't have any set wage coming in each month. If I don't get up and work, I don't get paid. On the surface, running your own company sounds fantastic, but actually sometimes it can be a real grind. If you are employed, there's a few things you can do to help reduce the amount of tax you pay, and remember to double check all of these on the government website because they do change regularly. If you pay for things with your own money that you use for work, you're actually able to claim for some of them. If you work from home, you can claim on things like gas and electricity, which at the moment might be more than you think with the current energy crisis. You've got uniforms and work clothing, vehicles you might use for work, subscriptions. Remember, of course, you have to use these for work, not just your Netflix subscription. There's also things like travel and overnight expenses, as well as any kind of equipment you might buy for work. These might sound like trivial things that you never really have time to do or never have thought of claiming for, but trust me, it's worth the time doing. The other thing you can be doing is paying into your company pension. Please, if it's good, do it. I've heard countless times of people who are able to take up pension contributions who've skipped over it as they would prefer the extra income. Of course, at the moment, some people might not be able to do that, because I know things are tight with inflation and the energy costs. But if you can afford to do it, do it, because you're not going to pay tax on that income at a basic rate. Now, if you're thinking about starting a side hustle, then you may want to consider how that affects your tax position. Even if you're not profitable right at this moment, you can start claiming for some of those expenses, things like startup costs, equipment, and training. And of course, I have to drop in my favorite side hustle here, match betting, just because what you make from that is classed as gambling. Even though there's no gambling involved, it's paid tax-free. Even if you don't want to do it on a full-time basis, I think it's worth trying to just clean up on the sign-up bonuses. It's literally an easy £500 to £1,000 tax-free you can work through in your spare time. That one you can find in my description if you want to check it out. I don't really know of any other side hustle that compares in terms of tax-free income. Now we've reduced our income as much as possible, it's time to look at utilising the right investment accounts. And speaking of accounts, today's sponsor Awesome are the experts in organising your business accounts, so you don't have to worry about filing company reports or paying your taxes on time. Awesome accountants take care of all your finance admin through their app, and they're always on hand to answer your questions and give you advice based on your company accounts. Track your finances while managing your payments and invoices all in one place, so you can focus on doing more like reaching new customers, building your brand. Get a finance manager at a lower cost with Awesome. The link down below is really generous and will get you a £1 VAT registration plus 2 months of free accounting. So if you do want to start a side hustle, they can be super useful. Okay, back to it. The type of account you open is going to have a huge impact on the amount of tax you pay. So there's 4 main types of accounts: the lifetime ISA, the ISA, the SIP or pension, and your GIA, which is your general investment account. The lifetime ISA lets you pay in up to £4,000 per year, and you get a 25% bonus. That's up to £1,000 for free. And as that money grows, everything is tax-free, including the gains and the dividends. You can either access that at 60 or use it towards a first-time house purchase. Now the ISA lets you pay in £20,000 per year, 16,000 if you put 4,000 into your lifetime ISA, and when that grows, again, everything is tax-free and the dividends. You can access that account at any time, but when you take the money out, it's not that easy to put it back in. You still are within that allowance. So let's say you've got £20,000, you put 5,000 in. If you take 5,000 out, you've actually then still only got a £15,000 allowance. Now you can get around that by going for a flexible ISA. They're not very popular at the moment, but that doesn't let you lose that account. So in the same way you take 5,000 out and you want to put it back in, there's still that £20,000 allowance. I think they will get a lot more popular as they start sprouting up. For the time being, I'm just in a regular ISA. Now the SIP is more complicated in that you can pay in up to £40,000 per year. 20% of this will be added as a bonus by the government, and as this money grows, you'll pay no tax on that profit or dividend, but you'll be taxed when you take that money out. You can take 25% tax-free at 55, which is going up to 57, and the rest comes in like regular income and is taxed in the same way. So you've got the tax-free growth on the way up, but you're taxed on the way out. The benefit of this one, of course, is that you're getting the government bonus and growth on that bonus along the way. The often forgotten about one is the general investment account. This is your standard account you'd open at most brokers if it wasn't an ISA. Within these, you're able to make capital gains tax each year. That's £12,300 and £2,000 in dividends. So that is an extra £14,300, and you can access this at any time. Now, the complicated thing about this one is the capital gains tax also applies to other assets you made a profit on, such as your property. You only pay this tax when you realise the profit. Each year, you need to be selling those shares and then rebuying them. Now, your tax strategy is going to vastly depend on your goals and your long-term plan. So take down these figures and pick your accounts based on your goals. I don't believe you should be taking a GIA over 100 to 150,000 unless you need immediate access. And the lifetime ISA, you can't put in more than 4,000 anyway. The main consideration is the SIPP versus the ISA. Let's say you had £1,000 to start with and invested 250 every month with an average return of 10%. The ISA would be worth 584,000 with zero tax due. The SIPP, on the other hand, would be worth 697,000. From there, you can take 25% tax-free, 174,250, and that would leave you with 552,750 in your pension, which would then be taxed like regular income. 12,500 tax-free, and then the rest is likely in basic rate. So depending on how much you need, you could actually be better off in a SIPP than an ISA. It's very close, but if you're in the higher tax bracket, it becomes a no-brainer. The other consideration, if you do have a business or you want to start one on the side, you can invest with the cash balance of the business account. InvestEngine have actually just started offering this option, which is a good reason to start a business. For example, you could build up 125,000 in cash balance by the time you're retired, and that would actually pay you your tax-free allowance for the next 10 years. So you can see just how important picking the right type of account is. So in summary, here's a quick checklist for you to follow. Keep your income in the ideal bracket, utilise tax relief on your pension, make sure you claim for every expense you can, consider starting a side business for more expenses, and make sure you're utilising the right tax-free accounts. If you do all of these things right, your tax bill should be as low as possible, hopefully even zero when it comes to your investments. If you have any questions about any of this, please let me know in the comments down below. And before you go, make sure you grab your free crypto card from CoinJar. They're FCA registered and you can start earning reward points when you spend crypto in real life. And you can redeem them for some cool things like gift cards, or you can use it to make your crypto transactions fee-free. And here is 2 more videos which I think if you haven't seen, they will really benefit you. Thanks for watching, and I'll see you guys over there.